What sets the stage for global financial reporting? It's the foundation of GAAP and IFRS standards. Dive into the backbone of financial transparency worldwide. GAAP and IFRS, these acronyms shape the language of finance across borders. Why do these standards matter? They ensure consistency and comparability in financial statements. Picture a common ground for financial clarity, enabling stakeholders to make informed decisions. This harmonization is key for businesses operating in a global economy. Stay tuned to unravel the intricacies of GAAP and IFRS, unlocking a world of financial understanding. What do accounting standards do? They're like the rules of the road, guiding how financial transactions are recorded and reported globally. Just as traffic rules keep roads safe, accounting standards ensure transparent and reliable financial reporting. They create a common language for accountants worldwide, fostering consistency and trust. So, when you see financial statements, remember, accounting standards are the backbone that makes them clear, consistent, and reliable. Why do we need accounting standards? Consistency. Imagine a world where companies use different accounting methods every year. Chaos. Standards ensure uniformity, making it easy to track performance. Comparability. Investors need a level playing field. With everyone following the same rules, financial statements become apples-to-apples comparisons. Transparency. Clear standards cut through ambiguity, preventing shady accounting practices. Trust. Standardized reporting builds confidence in the accuracy of financial information. In a world of numbers, standards are the foundation of trust. Welcome to Chapter 2, where we delve into the world of GAAP, generally accepted accounting principles. GAAP is the trusted accounting framework in the U.S., set by the Financial Accounting Standards Board. It lays out precise rules for financial statement preparation, leaving little room for interpretation. While this rules-based approach offers clarity, it can sometimes feel complex and rigid. So, how does GAAP shape financial reporting? Let's uncover the details together. What are the core principles that guide generally accepted accounting principles? First, the economic entity assumption ensures business transactions are separate from personal ones. Next, the monetary unit assumption records only transactions in monetary terms. Then, the time period assumption divides business activities into reporting periods. The cost principle values assets at purchase cost, not market value. The full disclosure principle mandates comprehensive financial statement information. Lastly, the going concern principle assumes business continuity unless proven otherwise. These principles form the bedrock of sound accounting practices, ensuring transparency and accuracy in financial reporting. Ever wonder how accounting standards ensure consistency across industries? GAAP's rules-based approach offers detailed guidelines tailored to different sectors, minimizing ambiguity but resulting in a maze of standards. The matching principle neatly aligns expenses with the revenues they generate, fostering transparency. And when it comes to revenue recognition, GAAP emphasizes earning over payment timing. Materiality highlights the importance of reporting key items that sway decisions, while conservatism urges accountants to err on the side of caution, preventing potential asset or income overstatements. These principles form the bedrock of financial reporting, ensuring accuracy and reliability in the numbers we rely on. Ever wondered about the backbone of global financial reporting? Enter IFRS, the International Financial Reporting Standards, embraced by 140-plus countries. Unlike GAAP, IFRS opts for principles over rules, demanding nuanced judgment. This flexibility simplifies standards but sparks diverse practices. Developed by the IASB, IFRS strives for a universal financial language. In a world of variations, IFRS stands as a beacon of global financial harmony. Ever wondered what underpins the core principles of IFRS? Picture this: financial statements as a mirror reflecting the true essence of a company's financial standing. With the accrual basis, transactions are etched in truth, not just the currency exchanged. Operating on the premise of a going concern, these statements envision a future in motion. And in the realm of substance over form, economic essence reigns supreme over legal technicalities. In essence, IFRS demands a transparent and forward-looking portrayal of financial reality. Ever wondered what sets IFRS apart? It's all about being principles-based, offering broad guidelines for accountants to exercise their professional judgment. This approach fosters global acceptance, with over 140 countries, including the EU and Australia, embracing these standards. By promoting comparability, IFRS makes it easy for investors to analyze financial statements across borders. Think of IFRS as the universal language of accounting that speaks volumes across the world. In the world of financial reporting, GAAP and IFRS may seem like distant cousins but share a common DNA. Both strive to deliver clear, comparable, and trustworthy financial data to investors and stakeholders. They march in unison with similar financial statements, balance sheets, income statements, cash flow reports, and statements of equity changes. Embracing the dance of accrual basis accounting, they record transactions at the point of occurrence, not when cash exchanges hands. Core concepts like going concern, materiality, consistency, and full disclosure are their guiding stars. In essence, GAAP and IFRS stand as pillars of financial integrity, bridging gaps and fostering global financial transparency. Ever wondered how accounting standards differ across the globe? GAAP and IFRS take contrasting approaches. GAAP leans on specific rules for guidance, while IFRS hinges on principles and judgment. This disparity shapes how accountants interpret standards. GAAP provides clear directives, while IFRS demands critical thinking. In a world of numbers, these philosophical distinctions are key. Ever wondered how accounting standards impact financial reporting practices? Let's delve into the detailed comparison between GAAP and IFRS. When it comes to inventory valuation, GAAP offers options like LIFO, FIFO, and weighted average methods, whereas IFRS restricts to FIFO and weighted average only. Revenue recognition under GAAP involves industry-specific rules, while IFRS follows a single, principles-based standard. Asset revaluation is mostly off-limits in GAAP, favoring historical costs, yet IFRS allows for fair value revaluation in certain cases. Development costs are expensed as incurred in GAAP but can be capitalized under IFRS with specific conditions. Financial statements in GAAP typically list the most liquid assets first, whereas IFRS lists the least liquid assets up front. The distinction of extraordinary items, once disclosed separately, is now omitted in GAAP but strictly avoided in IFRS. In essence, the choice between GAAP and IFRS significantly influences financial reporting practices. Why does consistency matter in accounting? It's crucial for stakeholders to track genuine financial trends without being misled by changing methods. When companies alter accounting practices, transparency is key in disclosing the impact. Consistent application not only builds trust but also enhances the meaningfulness of financial analysis over time. Think about it, would you trust a shifting foundation? Trust in financial data is built on the bedrock of consistency. Ever wondered how investors sift through a sea of opportunities? Comparability is their ultimate compass. It levels the investment playing field, letting them gauge companies equally using standardized metrics. And it's not just investors benefiting, lenders, too, rely on comparable financial data to make credit calls. From interest rates to loan amounts, it all hinges on this comparative info. Meanwhile, companies sharpen their swords by benchmarking against rivals. It's a strategic dance where comparable industry data reveals improvement areas and helps set realistic goals. In a world where data reigns supreme, comparability is the key to unlocking financial success. Ever wondered how financial reporting finds its structure and reliability? Accounting standards play a pivotal role in shaping raw financial data into actionable insights. Bodies like FASB and IASB lay down the rules, companies implement them in transactions, auditors ensure compliance, and stakeholders leverage these reports for informed decisions. This orchestrated process ensures financial reporting fuels smart business and investment moves. From guidelines to applications, from verification to utilization, standards are the bedrock of financial clarity, driving sound economic choices. Ever wondered how capital markets maintain their order and confidence? The answer lies in accounting standards, the essential bedrock of market efficiency. These standards ensure that investors can rely on the financial data they receive, safeguarding against chaos and enabling accurate company valuation and efficient capital allocation. With 140 countries embracing IFRS, global trust in standardized reporting is evident, driving a remarkable 95% market confidence when standards are diligently applied. In this intricate dance of trust and transparency, standards are the key partners that investors and markets rely on for stability and growth. In the realm of accounting ethics, professional integrity is paramount. Accountants must uphold honesty, resisting pressures to manipulate financial data, even in the face of management or client demands. Objectivity and independence are core principles, demanding unbiased judgment in financial reporting. While standards offer guidance, the ethical application necessitates unwavering objectivity in decision-making. Serving the public interest, accountants ensure the reliability of financial statements, extending beyond individual clients or employers. The consequences of ethical breaches in financial reporting are severe, potentially leading to the destruction of companies, harm to investors, and a loss of public trust in capital markets due to major corporate scandals. In this crucial chapter, we delve into the ethical responsibilities of accountants, emphasizing the critical role they play in upholding integrity and trust in financial reporting. In today's interconnected world, where companies transcend borders and investors diversify globally, accounting standards serve as the universal language of finance. The shift towards IFRS in many nations underscores the push for consistency on a global scale. Even the US, holding on to GAAP, strives to align with IFRS to facilitate international investments and reporting. This harmonization fosters seamless cross-border transactions and enhances financial transparency. In a world where capital knows no bounds, standardized accounting practices are the linchpin of a truly connected global economy. Why do future accountants need to grasp accounting standards? Because these rules are the very foundation of their work. From basic bookkeeping to high-level CFO positions, comprehension of standards is non-negotiable. Mastery of GAAP and IFRS isn't just a bonus, it's a prerequisite for prestigious certifications like CPA, CMA, and CA, paving the way for career growth. Moreover, being well-versed in both GAAP and IFRS opens up global opportunities, making you a sought-after asset in multinational settings. Not just about numbers, a profound understanding of standards empowers you to uphold ethical financial practices and safeguard stakeholder interests. As you navigate the world of accounting, remember, standards knowledge isn't just valuable, it's indispensable for your professional journey. In a world of diverse tongues, accounting standards speak a universal language of trust and transparency. GAAP and IFRS, though different in approach, share the same mission of guiding financial communication. Consistency and comparability are the bedrock of decision-making, allowing for meaningful analysis across time and companies. Remember, the ethical application of these standards safeguards investors and upholds market confidence. As our business landscape grows global, proficiency in both GAAP and IFRS is crucial for modern accountants. So, embrace these standards not as mere rules, but as the very pillars of integrity in our financial realm. Shape the future of financial reporting with understanding and ethics. Takeaway: uphold accounting standards as the cornerstone of trust in our financial system.